Assalamu alaikum, everybody. I will basically begin with a brief introduction about myself. Happy to answer any questions. My journey is long, about 2 decades in the US. So far, I graduated with my bachelor's from College of EME back in 1998. I did my PhD from Michigan State and then worked in industry for a few years. I went to University of Chicago for my MBA, and then that's where I started, trading options and just developed my interest in options trading. And about 10 years for last 10 years or so, I've been trading options, different strategies, still learning. I would say, it's such a complex field, but I'm very excited about them. I'm very passionate about them. So I like to share my experiences. Let's jump into it. So what I decided to do was to break it down in 5 sessions, essentially. The reason why this is like a pretty complex area. I mean, some of you may have experience in trading stocks and using simple strategies on day trading. Sometimes longer term vision on stocks, but this is more complex in a sense that you have to understand these are called derivatives, and why they're called derivatives is because the price is actually option prices are derived from underlying prices. So for example, you look at Apple stock, if Apple stock goes up or Apple stock goes down, the option prices will actually change in relation to stock price of the underlying security. So these are derivatives. What I will try to do is I'll try to go through fundamentals today, and then we will build on it in next 3 to 4 to 5 weeks, and try to do complex strategies which are important to based on your risk appetite and your method of trading and your approach. You can decide what is right for you and stuff like that. But my goal is to give you those tools and some of the knowledge that I've gained over the years, and then with experience it comes easier for you. So we'll go through these topics. So let's just start with the fundamental questions. Stocks are easier to trade. I mean, everybody can just open a brokerage account and buy 100 shares of whatever you like. If you're bullish on something, you can go and buy a stock, and if you are obviously bearish on something, you can sell those stocks, short the position, and so forth. But what is the advantage of options is essentially where I'm coming from, and I think the fundamental reason why options actually came into existence, and nowadays they are heavily traded. I mean, when I'll show you some examples, I'll show you there are thousands of contracts that are traded. So the main reason is leverage. If you have $10,000 and you buy shares, you are just gonna get based on the share price, you're gonna get, let's say it's $100 share, right? And you have $10,000, so you are gonna get $1,000 shares of something, right? And 10% gain on that, on $10,000 is just gonna, and 10% is not every day you get that, but that's $1,000 made. But options can actually magnify your profits, and unfortunately at the same time they actually make you suffer huge losses. So basically it's the leverage. You can double your money in a matter of 1 or 2 days, and you can lose all the $10,000 in a matter of sometimes in a matter of minutes. So we will talk about that, what to do, what not to do, as I build through it. But the concept I want to give you, and sorry if I'm repeating, some of you may have expertise in options already, but I'm assuming that I'm talking to somebody who has no experience in options. So apologies to those who already know some of this, but it's all about leverage. I would say affordability is a key point. I mean, if I have $500 with me, I can trade options and generate huge profit. Downside risk is that I will lose my 500. But if I'm right on things and if I trade them fine, those 500 can take me to 5,000 or 10,000 or 50,000 or whatever, right? It all depends on how good you are and how you can actually deploy your options and your strategies and stuff. But affordability is key. Not everybody has thousands and thousands of dollars. You can You can start trading some weekly options just as little as $100. I mean, I literally say that, and I'll show you. Uh, Cost efficiency, which is kind of a related concept, is that it's all about effectively so putting less money you can gain more. So it's more efficient rather than bringing all your savings into stock market and deploying it that way. But these are fundamental concepts. But as we see the real-time examples and get deeper into the weeds, you will get a better understanding. A lot of people use it as an insurance policy against their portfolio. So let's say you have $100,000 stock position on something, any big stock, and for whatever reason you are a little bit worried about it going south. That way, what you could do is you could buy a put option on it. And that way, if it goes down, that put option will protect you. It's like insurance, like you buy on your house or on your car. You put $25,000 on your car, and you don't want to, unfortunately, or God forbid, getting into an accident and losing all the 25,000. More importantly, I mean, your life. But talking about the money, that 25,000. There's an insurance policy you buy against your property. So same thing, options are an insurance policy on your portfolio. If you're like back in 2008 and back in every time there's a recession or market tanks 20 or 25%, those put options will save you. Or not market, even the stock can go down against you, and that's where. So a lot of people use it. That hedging is a little complex topic. I will get into that, but it's like you hedge your portfolio for large movements against yourself. It's kind of similar to insurance, but you hedge your portfolio, you hedge certain bets on and using options. I already talked about magnified returns, like a $500 or a $200 or sometimes even $100 can actually make you. I mean, I've lost a lot of money in options also. I've made a lot of money in options, but it happens like I think it's better not to commit too much capital in it. If you are smart, if you're good, if you understand them, you can convert $500 and start your journey from there. So they magnify the return. How often you have gotten you double your money in stocks, unless you go in penny stocks and those little stocks where sometimes morning news comes and they're double, triple and all that. But generally those stocks move 5, 10%, 15, 20%. But in an option, I'll show you when we get into that, a strong move can actually, I've seen people making astronomical returns. But at the same time, I will tell you, you lose money very, very fast. And that's what my goal is to understand, to tell you how that works. Limited loss, yes, 500 is all you're going to lose. I mean, there are very, 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 very rare cases that funny things happen, but the worst case, the brokerage can take only that 500 that you have in there. If you have 75,000 in the bank, and sometimes there is, and we'll get into that maybe in session 5, but generally 99.999% you will only lose what you have in the bank. I mean in the brokerage account. So limited loss is very important on a stock. I mean, generally people deploy 20, 30, 40, $50,000, and they basically there's no end to it. You'll keep losing every morning. You wake up, you look at, and it's going down, down, down. And so, but on an option, I tried something, $500 over. Maybe 2 months down the road, I'll try it again. So it's a limited loss. So now we are going to actually start getting into things. Options are traded in 4 ways. You can buy call options, you can sell call options, you can buy put options, you can sell put options. We will get into details of that. But these two, the ones that are at the bottom, selling options is a topic for maybe, I don't know, 3rd or 4th session, and that's more powerful in my thinking. I think the buying options puts you in a risky situation. Selling options against stocks, especially, or against leaps, long dated options are some of those strategies. But eventually, when we are in session 5 or something, we will come to strategies that are very, very sophisticated, and that's when you will appreciate the power of selling the stocks. But selling the options. But right now, it's a little premature for me to start talking about that. I just put that in because most people, I would say 80 to 90% people are buyers of options, calls and puts, which is, I'm not against it. You buy the options, you you protect yourself, you hedge it, you do anything you want. But keep in mind, I'm not going to go through details of selling options right now, but buyers of calls, buyers of puts, that's what we are going to assume ourselves for today, and maybe in the next week. And for now, we'll stay there. We'll come back to this concept a little bit later. At this point in time, do we have any questions? Do we have any questions from anybody, or should I keep going? Okay, seems like everything is good. All right, so let's start from basics of option trading. What are options? Defining an option. Okay, so let's start from the basic buying a call option, right? Buying a call option on a stock basically means that you have a right, but not an obligation. You have a right to buy the stock at a certain price. At the expiry. So basically what I'm trying to say is that, let's say today, NIO stock or Tesla stock, is trading at a certain price, right? You buy the right that, okay, let's talk about NIO, right? NIO is a, obviously electric vehicle company. Most of you know it, right? If I buy a call option on it, what I'm saying essentially is that if I buy a $20 call option on NIO stock, basically that means is that I have a right to buy NIO stock at $20 a share at a certain date. That's important, within a preset date. So basically, if I buy a weekly option, that means after 1 week from today, next Friday, I'm entitled to buy NIO stock at $20. Now, NIO can go to 30, it can go to 40, it can go to whatever it can be, or it can maybe stay only at 20, or it can actually go down and be at 19 or 18. And we'll talk about that. But it gives me the right to buy 100 shares of NIO. That's one contract of option, and we'll talk about that. I can buy 100 shares of NIO at $20 on next Friday if I buy a weekly call. Now, obviously, it will be great if NIO is at $22 a share. That way, I can buy at 20, and then I go in the market and sell it for 22, and I make $2 per share on 100 shares. That will be $200. We'll talk about that. Don't worry about it. I'll show you exact mechanics of how it works. Why we call security has its own terms and properties is because you set your own expiry, you set your own strike that I want to buy NIO at $18 a share, $20 a share, $22 a share. All of that is in your control. You can buy the call option or put option, whatever you want. You decide to buy a call option. There's a strike price. We'll talk about that. That I want to buy 100 shares of NIO at $18 a share on Friday, October 24th, October 14th, or whatever expiry you select. That's why they have their own properties. You pick and choose. And there are two basic types of options, calls and puts, but there's a lot of combination of how you can combine them, buying two calls and one put, or buying two calls, selling one call against the same security. So all of that will come into picture over the next few weeks. But right now, calls and puts. Think about that, and we'll spend a lot of time on these two today, just to make your concept so that you understand what the mechanics is. So moving on. So let's get into some of the nomenclature, just to understand what that means. So this is typically how you will see an option, a one-liner, okay? What it tells you is, this is the underlying NIO, or it could be Tesla, or it could be, US Steel, or it could be American Airlines or something, whatever underlying, that's what that is. October 9th is expiry date. So 9th of October is when I have that right to buy 100 shares of NIO. That's the date I'm selecting. Now I can select December 15th, or I can select, obviously you can't select every date. There are some defined expiry dates, and we'll talk about it when we get there. I'll show you. But this particular one is actually showing you that NIO stock, October 9 expiry, October 9, 2020, obviously. There are leaps that are up, 2 years up in the future, but those we'll cover later. Strike is 20, so I can buy NIO stock at $20 a share, and obviously that option, that's not a free bet, right? $20 a share, you have to give some money to the seller of the option so that you get this right, this contract, right? So you have to pay something, and that's called the premium, right? So what this means is that option price, or I will change the word back and forth by price and premium, but they mean the same thing. That's what you pay to get that right to buy 100 shares of NEO stock on October 9 at $20 a share, right? So this is the most fundamental thing in options, the premium. Everything is there. I mean, sooner or later we'll talk about option pricing models, how people price these options, but that's not a topic of I mean, when I did my MBA, I specialized in option pricing and some of that. There, because University of Chicago is pioneer in options. I mean, there is Black-Scholes model originated from University of Chicago, and now there are Monte Carlo simulations that are used in Wall Street to price these options. But that's not a topic of our interest because we take the price as given. Sophisticated users, they learn if it is overvalued, undervalued, if they're asking too much money for it, and we will get into that level of detail. But for now, that's what you take it as a given, that they are selling NEO options, call options, expiry October 9th, 20 strike for $1.63 per share. So for 100 shares, I take that $1.63, multiply by 100. So I am putting $163 for this bet. And now the power of leverage will start coming into play as I build through these next 10 or 12 slides. And that's why I said you can start with $200 and start this, or even $100 sometimes. But if imagine you're trading and you just get excited about it, you say, you know what, for 5 days I'm gonna own 100. Not the word own is not right, but I'm gonna have the option to buy 100 shares of NEO at $20 a share. Now, pray to God that maybe that 20 in NEO actually goes to $23, $24. But they are smart. They price it at $1.63 so that your profits actually start after $20 plus $1.63 that you already paid for it. So it's basically start at $21.63. So if it goes past $21.63, so you start making money. And I'm going to come to all that in actual demonstrations. But I'm not talking too much about options. We will come to that. It's a similar concept. It just goes down, and we'll talk about it in a minute. But at this point, before I get deeper into it, I will actually open it up and see if anybody has any questions at this point. I don't see anything in the chat, but happy to answer anything that you may have. All right. Seems like no questions, so I'll keep moving. So now we're gonna get into options, like really into some of the mechanics of. First of all, the goal is to understand. Actually, I'm gonna pull my brokerage account here and see. So basically, here on the left, these are these expiries they are giving you, right? So these are already expired, 2nd October. So 9th October, that's the most exciting one. Next Friday, coming Friday, right? So basically, first thing, you select how long you want to hold it, right? I want it to be for 35 days, 105 days, 231. So this is the expiry. Basically, so you, first of all, I mean, most of the brokerage companies are going to look like that. I mean, you could go to Interactive Brokers, you can go up. This is TD Ameritrade. I mean, Think or Swim platform. I mean, this is heavily used, but there's Trade King, there's all of those. But generally, the concept is the same. They'll list these expiries, and they're all the same. Every brokerage company, they offer the same options. They come from Chicago Board of Option Exchange and all that. I mean, this is beyond the scope of this. But so I have actually a position on NEO on 16th October. Let's look at that. So I think, and okay, let me see if I don't want to go off track here. Okay, so I talked about call up. So left side here, this is call option prices, right? So how I'm going to read this, right? So at $20, so this is the strike. See the column here. So they're giving, and so NEO is a very liquid stock, and I like that, and that's why I trade sometimes on it, because you see that the expiries here are, I mean, there are a lot of expiries. Number one, there are weekly expiries available. some of those options will not have that, and we'll talk about those later. And then these strike prices. Now, these strike prices basically means is that I can say that I need to have the right to buy NEO at $18, right? Then you will pick this one. If you want to have a right to buy NEO at $17, you'll select that one, right? Obviously, these prices are actually going to keep going up, and we will talk about that in a minute here. But so on the left side, this is bid price and ask price. So basically, a $20 strike, which strike, or you can call it exercise price or whatever, but this is strike price. This is what we call it, right? So strike price $20 for 2 weeks expiry, 15 days, is trading at 259 and 261. So that basically means that first of all, before you start trading options, you have to see the bid ask spread, and I think I have some slides on it, but you do not, and options this is very liquid because you have so many contracts here, but you don't trade options where you see that the bid ask spread is a lot. This is like, hey, if you want to buy this car from me, I charge you $10,000, but if you want to sell me, that's $5,000. In stocks, this is very efficient. Generally, there's 1 cent bid ask spread, but you don't get into a trade when somebody says, okay, you want to sell me the car, I'll only give you $5,000, but if it's the same car you want to buy from me, pay me $10,000. That's not the fair trade. And that's why you always look at bid ask spread, and they should be very close, just like stock. Now, people using stock options, stock trading, they know that these bid ask spreads are very little in stocks, but that's a huge issue in option trading, and you always look at those. This right here is something called volume. So how many contracts of this traded on that? These are the options to that, but generally there's open interest, which basically means that many contracts are active. So that many people have either they have bought those options, they have sold that option. So this number should be in thousands or at least in hundreds for a stock to be liquid enough. I have some options where there's only 10 or 15 contracts, so that pricing will not reflect properly. So it's just not, sometimes you get crazy and you buy some leaps that are not liquid, but generally we'll talk about this more, but I think this is important to see here, that volume of contracts traded on the left 2 columns. Same thing on the put side. There's a lot of volume here in these columns, which is a good sign. Implied volatility, park that for session 2. We will get into that. It's basically how volatile the stock is. So stock like Commonwealth Edison or these electric companies or these stable companies is not going to move a lot. So they will not charge you high premium for that, and that's why the implied volatility will be low on those. But a stock like Snowflake or Tesla or these heavy movers, strong movers, there's always this high implied volatility, and we will talk about that. That's the topic of week 2. That how you scan for volatility, and eventually after week 5, you guys are going to be smarter than me in finding some of these things. But these volatility plays, there are some, we'll talk about the option Greeks like Vega of an option. You basically how the volatility of an option changes the price and all of that. But let's not get in there right now. I don't want to, make this harder. But so bottom line on this slide was you select your strike. The expiry 16th October, 15 days from today. You select the strike you like. That what is the price at which you want to buy NEO on Friday. 2 weeks from now, actually. Then you go in your pricing and see if there's any bid ask spread there. It should be very tight. And then the volume, also look at that, if people are actually trading it or is it a dead option just there. Delta is the single most important thing in options trading. We may get, I'm on the time side, we may talk about it, but it's a major topic for week 2. It's actually, just in one line, is that it's how much price of an option moves as the stock price moves. So remember, options are derivatives. So the price of underlying moves and then price of option moves, and that's when you get the benefit, right? If the underlying stock moved strongly on one direction, hopefully in your direction, the prices of options will also move strongly. So that 2.59 will actually be 3.2 or 3.3 just because the underlying moved from 21 point, to say 23 or something, and that gradient or that like how fast and how closely it follows the. So if a delta 1, basically delta 1 means, so these deltas are actually numbers between 0 and 1, right? So a delta 1 would actually mean that it's like stock. A stock moved $10, option also moved $10, right? That's the ideal case, but there are issues with that. And I'll get into that later. But the point is 0.7 delta. What does it mean? It means that if the stock moves by $1, option price will move by 71 cents. So that 2.88 will actually become like 3.5 or 3.6 if NEO moved $1 up. And that let's go through that in a minute here. And then, as I said, it's very complex, but I hope you are following me. And let's get into some mechanics of this. We can always come back to this. So, so there are some terminologies that are important. Strike price, I already explained you what it is, so I'm not going to go and talk about it again. We can, if you have questions, we can discuss it. Expiry, we already talked about it. These are your expiries right here. These, left side, these 9th October, 16th October, so forth, right? So you know expiry, strike price. The strike price is the price at which I want to buy the NEO stock on this date. Very, very important concepts: intrinsic and extrinsic value. I think I have something nice on this. I'm gonna actually talk about intrinsic and extrinsic in a minute here. But park that. It's okay. Before that, so there's in the money option. What does in the money mean? So in the money means that if today I buy NEO option, sorry.
Yeah. So we have some questions. So I think we can take the.
I'm sorry. Oh my God.
Yeah,
okay.
No problem.
Sorry, I was seeing my screen, so I couldn't actually hang on. Okay. So you have option to buy only on expiration date or any time leading up to expiration date. Not any time leading to the expiration. Okay. I think you're asking that you can trade the option in the meantime. Yes. So American options, you can buy and sell them anytime. You can buy the option now and sell it in next minute. That's totally fine. Yes, you can buy and sell anytime. You said, so you have the option to buy only on expiration date. That's your strike price. You can only choose that, yes, or any time leading up to that expiration date. You can buy even to, when the market is open with that expiry. But the important question that I got out of your question is something that I should have told earlier, is that you can, just like the stock, you buy a stock, after 5 minutes you sell it, you can do it. I hope I answered the question. The second one is delta, not variable. Sure, it is variable. It's gonna change by the minute. As the stock price goes up, the delta goes up. That's why people say don't buy stock options with the delta of 1 or 0.95, because then you don't get those called delta effect, which basically means that because then what's the point? If you are buying delta 1, I mean, it's still a point, but if delta is 1, that means that you're not really using leverage. Very good. So that's the point. So yes, delta is variable. It will keep changing, and as we go through it, I'll explain how it's going to change. A catalyst can drive the price strongly in 1 week due to a new stock. So does the delta keep changing? Yes, delta will always keep changing. Even after 2 minutes, you see delta will probably go from 0.71 to 0.72. Now, if you buy an option that's out of the money with a very small delta, 0.2 or 0.3, then you have a lot of contracts. And this is the beauty of it. Just give me like maybe 10 minutes and we'll see the power of options and how that leverage and that, I have a slide for that towards the end, that how that leverage gonna work, and sometimes buying more contracts and having lesser delta in the same money is. So let me slow down. So let's say you have $1,000, right? And you want to trade on NEO, right? So on NEO, you can just buy like 2 call options at 15 strike. Well, they're probably going to charge you 5 because it's by $6 in the money. So they're probably going to give you only 2 contracts for that. If you say that, it's okay, I want more contracts. I want to be able to, in that $1,000, I want to actually be able to sell 1,000 shares, to buy 1,000 share exposure. Then you are actually playing big. and there are risks with that. And that's why I said you can double your money very quickly, double or triple, or so it really depends on if you really believe in your pick. So allow me 10 or 15 minutes and we will talk about this effect, the leverage versus just buying a stronger delta, like delta 0.91. I generally don't believe in delta 0.9 or 1 because that doesn't give you enough leverage. I think what he meant was if you can exercise an option. Okay, you never, and remember this sentence always in your life, whenever you are trading options, you never ever exercise an American option or these options. You never exercise them. Why? Unless you have a severe kind of call or some, because of you will lose money on it. You just go and sell in the market. You just simply click and sell it. Exercising is different. You're losing the intrinsic value. And again, when we get into my Excel file, you'll be able to see it. But never exercise it. Never. This is one of the first lessons we got when I got into it, is that it's almost 98% of time never optimal to exercise, because you're gonna lose that extrinsic value or the time value you gave for the option, because you bought 3 weeks of time and they charge you for that, and if you exercise it, that's all gone. So I'll show you in a real example, but just hold on for that. Yeah, I think it's probably a good time to get into the weeds of this, how that works. We can have more questions, I mean, as time comes. I mean, I'm sure that it's a little harder for me to get at that level. Some of you may actually know some of these already, so maybe that's more repetitive, but I'll make sure that I'll address some of these questions. We'll come back to that. So in the money, what does that mean? That means that you buy something that has a lower strike price for a call option, lower strike price than the stock price. So there are two things: strike price, stock price, right? Strike price of 20 today for NEO is in the money. Why? Because NEO is trading at 21.18. So you are already getting $1.18 because you're buying in the money. However, if you think that the news is going to come tomorrow or later this week and NEO is going to be over $25, you can buy a call option with a strike price of $25. But guess what? That's out of the money today, and this will be really cheap for you because you are not getting some already in there, and that's what I tend to try to explain in these slides right here, which basically means when intrinsic goes down, extrinsic goes up. So we'll maybe in 15-20 minutes we'll be there. But the question is that, so the intrinsic value is something that you already see, right? It's already there, it's built in there. Extrinsic value is purely time value of the money, because they are giving you right to hold that option for 3 weeks, 4 weeks, 5 weeks. They're going to charge some money for it, right? And that's generally in addition to the intrinsic value. So option will always have an extrinsic value, but not an intrinsic value, because intrinsic value could be you could buy out of the money option, and that's a related concept. The out of the money option, I already told you, like today NEO is at 21.18. You buy an option at strike of 22 or 23, that means it's out of the money. So currently it's not, its strike price is actually if it's out of the money, it means the strike price you're picking is above the current trading price of the stock. Premium, I already talked about that option premium, the price you give, and it's actually generally the addition of intrinsic and extrinsic value. Intrinsic and extrinsic value added together gives you the premium. That's what you have to pay to have that right. Exercise, we talked a little bit about. Exercise basically means, okay, give me my shares. Okay, today I said that at $20 strike price I have NEO, and I see that it really performed well, and it's at $23 on Monday morning or Tuesday morning. So give me. I'm today happy to buy at 20. So I'll buy from you at $20 a share and go in the market and sell for $23 a share. And guess what? I made $300 on that because 100 shares I was holding and $3 in the money. So I'll get $300. But all that is easier to see in Excel. But the point is, you are always going to lose some money because of the time they have already had it. It's better to always sell it in the market. Now people exercise because of other reasons which we will get into later. But for now, it's okay. Assignment is the other thing. You sold an option and somebody says, okay, deliver the shares. Okay. Assignment is something that is, if I'm a seller of option, I give you this, I don't buy that right, actually sell that right. Okay, I will deliver. If NEO today is $20 and I am selling that option for $1.63 and tomorrow it goes for 23, then I owe you shares at $20. So then I have to deliver. So they assign you, say, okay, give me shares at $20. I'm going to go in the market and sell it for $23. I make that $300. So that's when somebody asks you to give it. That's assignment, and exercise is opposite. Very, very rarely that happens that people get assigned. I mean, I would not say very, very rarely, but it does happen only when option is deep in the money and when there's really not time value. There's no time value for money left. But it's all good when we see it in Excel. Maybe there's questions there. I don't know. I'll just check it quickly. Okay. All right. Let's. Okay. Wait. Okay. On the time we have like 25 minutes. Okay, so so let's start with call option. A simple long call is a strategy. Tomorrow, and we'll stick to our NEO stock. So basically, I'm gonna go here and actually pick the example that. Let me see what example I put, because I'm holding one. I can give you that one, but let's just say that 9th October, 20 strike. Let's talk about this one. Okay, so next Friday, the Friday 9th of October, right? I think that today the $20 strike, if I select for 5 days, it's gonna charge. And remember, these bid-ask spreads, generally you will get execution at $1.63, or could be $1.64, but never pay as a $1.65. I mean, always execute the orders. If I say buy this, right? But generally, see, they give you midpoint is $1.63. So if I give it $1.60, probably gonna get executed. But assume that's $1.63, right? So let's go back in here and we delete it and we look at where we were. Okay, so let's start with this example here, and I'm gonna build it very, very slowly so that we don't lose people who don't get it or whatever, right? So long call. Okay. All right. So first of all, I mean, this is something that I just made for this purpose, just to explain you how it's going to work. But let's say we pick NEO, and today the stock price is 21.18, right? And I picked the strike of 20, and I paid a price or premium of $1.63 for an expiry on next Friday, 9th of October, and I only selected one contract, right? That should be pretty clear by now. I mean, I could change these based on what I feel, but my goal is to tell you how the leverage works and how it's going to work. So now, a few things can happen to NEO. Probably could be at $15 on Friday, or could be at $30, or could be more. But let's think that this is going to behave normally, and it should be somewhere in here range, right? So now, how the P&L will look like, that's the most important thing. And this is very, 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 very basic right now. Okay, this is just to show you what's going on there. Okay. First thing first, on Friday, NEO was $15. Guess what? I'm going to lose my $163. And that's 100% loss, right? That basically means that I played the game. I gave $163, hoping that NEO will be more than essentially break-even point, because I want to make money. But if you paying somebody $20 is where you have the right to buy, and they're already giving you for $1.63. Right? That's not going to come back to you, right? Now your break-even point in a very simple calculation is actually $21.63, because otherwise, well, at 21.63, you actually made that $63 back, right? And this is the most important part of the day, okay, to understand some of these concepts, right? So at $20 strike, if the stock didn't move much, and from 21.18, which is the current price, it just moved a little bit up at 21.63. Guess what? I can sell it, and I can take my $1.63, because remember, its price is gonna be probably $1.70 on Friday, because maybe 6 or 7 cents they keep it until the very last minute, because that's the extrinsic value. But we'll come back to that again. That's not related right now. But assuming that you'll get that $1.16 money back, Now, what will happen if it's 15? Well, you lose all the money. Sorry. You lose 16, 17, or if the strike was 20, you still lose all 163. And the reason why that happened is, guess what? You strike it, your option is just barely at the money, and you lost $163 because your right was to have anything over $20, right? And there's nothing over $20. So just to play that game, that premium is gone. So that's one side of the option, is that you lose everything. And don't do it. Put your $20,000 on Neo for next Friday, and then on Friday, for whatever reason, it doesn't go above your break-even point, and then if it stays below 20, then you lose all the 20,000 because you bought a lot of contracts. You didn't buy one contract. You probably bought, you could do the math. $20,000 divided by 163 for one contract, right? So yeah, you probably bought 122 contracts. But those hedge funds, they do it, so nothing unusual. But anyways, now let's start about the profit side of things, right? Let's say Neo was at $22, right? Hey, guess what? That's nice. Why? Because I paid $1.63 for it, right? And today it's at 22. So 22 times 100. So that's because I have 100 shares on it. So by the way, each option contract by default has 100 shares on it, right? You cannot just buy like one share option or one contract would be 100 share. Deal is 100 share, right? So that's why I multiply everything by 100, right? So so the point is that if it goes at $22, right? So basically, I'm actually 22 minus 20, about $2 in the money, right? So I'm actually $2 in the money, but I also paid this $1.63 for it. So that's why my profit is really, $37, right? 0.37 per share. So you multiply by 100, you get, you made $37. But look at the return, $37 risk when you put risk 163, right there, 27% gain, right? And it barely moved, right? So now you see that the power of options, right? And guess what? If it goes $23, right? Now we're talking, right? Now $23 means this is going to be 23. You made $3, but then you paid $1.63 for it, so you got 137 money. You made 137 divided by that, 84% return. How often that happens in a stock? Unless you buy those biotech small penny stocks. So your power is right there. If you're right on Neo, guess what? You make a lot of money very quickly. And then if you're really right on Neo, for whatever reason goes to 25, then you know what's going to happen. Then it's 337 after your that, and if you put that, let me give that. So so then you're looking at 206% return right there. So that's why I said you could do this with $200 on a weekly basis. Say that my paycheck was not as good as I thought, and then keep putting $200 every week, every Friday. Actually, the leverage is much stronger at 200 on a Friday, just because of, and I will talk about that later. But that's the power of options. On a 1 week bet, you placed 163, and if you're right on Neo and it went to 25, you made 200% return on that. So the risk profile looks like this: you lose everything, your $163 all the way into 20. Then you start, you paid, you actually will break even at because you paid $1.63 on it. So you'll break even at 21.63. So that's where that is. And then there's unlimited potential. If Tesla buys Neo or whatever happens, guess what? All of a sudden, if it's $40 stock, then you know what, I mean, then obviously you become rich very quickly, assuming that you put a lot of money in it. I mean, one option will probably give you, if you're only putting $163, then 200% return will still only make 337. So that's the downside. But again, win after win after win can grow your money very quickly. And that's the profile of a long call. I have this nice calculator here. It just works very, when we will, and I got it from the web. So, I'm happy to send it to you, but you could buy multiple options, and so this is very easy to use. So you say it says stock is Neo, and I want to plot it at a $1 increment. So starting from 15 to basically just what I did. I mean, you can make your own. I mean, but 15 to 30, give me the payoff diagram, and then I'm basically doing this. I give the strike of 20, and I say the current I paid $100.63 for it, 100 shares in one contract. So my cost is 163, and then it'll give you a similar diagram, and that's exactly the same thing. That you lose all 163 up to $20, and then you'll have to reach 21.63, after which you'll actually truly become positive. So that's, I mean, it is not that hard for basic ones. I mean, I at some point made my own, like butterflies and condors and all that. We'll get to that maybe in week 5. But you could play with it. I mean, you can buy these other and make your graphs, and there's a lot of information up on the web. You can buy, you can download these free, or I mean, for a few bucks you can actually get a good one. And by the way, this actually does all this for you. So whatever brokerage firm you, so let's analyze that a little. So you go here and you say that, okay, I like that, so I'm gonna buy it, right? So you click on it and you say, okay, I'm gonna buy. I don't want to buy 10 of them. I buy one of them. Neo 9th October 20 call single, which means I just want naked call option. I'm gonna set my price to $1.63 because that's the midpoint, and then I will analyze it. I want to say right click and analyze trade, and it's gonna say that, well, I probably have more than one select. So I don't want that. Yeah. So it's going to give you the profile, the same thing right there. So basically it's telling you, well, it's a put option. Hold on, something wrong. I just need a call option. Oh, sorry. Yeah, call option. What's wrong with this? Did I, let's just get off from it. So I just want to buy in 9th October 20 call, this one, single. Yeah, that's the same chart. Okay, so yeah, and we'll get fancy when we will actually select a bunch of these together and see how the profile looks like. But it's a good tool there that I didn't want to show you directly. I wanted to do the calculation right in front of you so you understand what's going on there. Getting back to where we were, I don't know how the question, but so let me, okay, if you are buying contract for 20 some, hold on. It's generally those options that come from Chicago Board of Options Exchange. So basically, they're priced by them. But yes, you could be a buyer or a seller. You also have the right to sell those options as well as you can buy them. But the brokerage will not allow to sell naked call or naked put options. Why? Because that's its unlimited loss. What if you sold me Neo $20 strike, and let's say the Neo stock reached $100, and my broker, I mean, my account is only $500. Then what? Where do they make their money back? So they will not let you sell naked calls and naked puts. But I have a workaround that, which I'll tell you very, very late in the game, because you can have multiple brokerage accounts, and there are strategies that are built around that. But generally, you will go to any brokerage, they will not let you do that. It's a level 4. So there are different levels of option trading. Level 4, level 3, or level 4 is what they generally give you, and these are those spreads that you can do, which we'll talk. But they will generally, those are institutions, and there are some special requirements for naked selling. So assume that you cannot sell naked call options, but there are ways that I'll tell you later that kind of simulate that. And you can buy and sell anytime. Stock price could be higher than 20 or lower than 20. You can always do whatever you want to do, as long as you can still sell an option that is higher than the stock price or lower than the stock price. That's all fine, as long as you are following. And I mean, anything in yeah, you could just click on this sell, and you can sell it. But guess what? When I try to do that, it will tell me some error that you're not allowed to do that. And that's very rightly, because what if the stock moves abnormally and my account only has, like, say, $1,000? I mean, who will be responsible to do that? So that's why they don't allow you doing that. But I think that's okay. So the stock price is at 25, am I selling the option or exercising the option to buy at 20? You can do both. You can sell it, you can exercise it. But in this case, on a Friday, $25 option will be actually traded only at 5.1 or 5.2, not even 5.2, it will be 5.1. Why? Because basically they'll give you only the intrinsic value. So 25 minus 5 is what you are entitled to. So that $5, and if you just go on the market, you can probably sell it by 2 or 3 cents over, because they will give you that 5 cents just because of the 2 or 3 hours that are left there. But that's a bigger problem if stock price was $22. Why? Because from 20 to 22, and that's where the concept of extrinsic and intrinsic will come. That there's a lot more time value. If it's a deep in the money option, like you just mentioned here, that 25 and 20, that's deep in the money for a Friday as a same day expiry. They'll probably, so delta is 1. They will give you $500 for that. But don't exercise it. I mean, you could exercise it maybe, I guess, on Friday, like 20 minutes down before closing, but don't exercise it if there's a lot of time left in it. Let me put it that, and then I'll explain you why I mean that. Okay, so now this stuff I kind of covered it already. I mean, these generally I've explained it in a different way, but time erosion hurts. Let's talk about that. That's a theta effect. We will talk about that next time. But generally, I've covered this. We already talked about it. This is how you enter the order. Generally, in your brokerage, if you go to Interactive Broker or other ones, it's probably going to look very similar. They'll ask for you how many contracts. They'll ask you what is the stock, expiry, strike, call or put, and then give the price, limit order, do it, done. So that's generally the controls that they will ask you to fill in, and then they will give you the price like I did here. And then you say, okay, I really don't want to, I want to buy it for $23, and I'll wait for it to drop further and then I'll buy it. But that's how the orders work here. Let me see. So let me see. I really wanted to talk about these two. These are really, really exciting stuff. But let me spend 2-3 minutes on long put. I mean, it deserves a lot more, but it's exact opposite. What that means is that I'm bearish on the stock. So I think, hey, NEO is going to drop. NEO is going to drop to 17 or 18 on Friday, right? Now what do? I could go to my brokerage and I can just put $2,100 and short 100 shares, right? But I don't have $2,100 to do that, right? So what options do I have? I'll go put. So I'll basically do this. I'll go here and I'll say, okay. So I'm gonna buy out of money put, which basically means that I think it's gonna drop below 20. Now look how cheap it is. Why it is cheap? Because it's deep out of the money. First, it's gonna cover the distance from 21.18 to 20. And then that 42, because you paid it, so its break even is actually gonna, so after 19.58, then you're gonna start making money on it. So that's why I will never advise you to buy out of the money options. I will always recommend to sell them. Give it to somebody else. You tell me, would you take that or would you not take? Well, people take it. A lot of people do it. They like to have put options out of the money put options. Why? Sometimes I'm holding shares of NEO, so I'm actually bullish on it. But hey, what if it drops down to 16? My put option is $42 on an insurance. So okay, let's talk about insurance, right? So 21.18 times 100 shares I buy on just without any leverage as a stock. I'm talking 2118. So that's the money I need to, if I'm going long on it. I'm like I think it's gonna go up. What you can do is, just to protect those, you can just buy $42. You just put 42 as an insurance, that if it drops below 20, guess what? My put option starts gonna deliver for me. And these are long-term holds, right? I can wait a year or 2 or 3 years on it, but this 42 will quickly cover me, because guess what? When it drops, the more it drops, you are actually gonna keep making money. What happens if NEO goes? Let's talk about file here. Okay. So if NEO goes 15, what is your profit? So basically, you are holding a 20 put. So you'll take 20 minus that 15. So that's $5, and then you paid what? 42 cents on it. So you are gonna make $4.58 on an investment of 42. no, 450. Yeah, so I think I can do it this way. So I'll take the 458 and I just divide by 42. Look at the percentage. So I made a lot of return on it because of yeah. So see the return, because it worked for you. You were so right on it that NEO will drop because of some, so that's why, if that happens, it's a good trade because you are holding those shares. So how much you lose on the shares is 2118 minus now price is probably 1500. So you lost, you lost $618, but then you made $418, $458, right? So your loss is actually only 100 shares, right? You lost 160, but cover it now, cover the put option, and let the stock run. I mean, you have unlimited time on stock. Its delta is 1. It will move up, if not this week, 2 weeks, 4 weeks. Well, if you are truly wrong on this and this actually goes at 10, then maybe buy another put option. Maybe buy another week put option at 15 and cut right down. That's power of this is called insurance or hedging. That on a $2,118 position, you're putting $42, saying that if it drops severely, I have that protection. In fact, sometimes I actually want them to drop because I made a lot of money on this, and then I can wait for NEO. And actually, I can maybe buy another put option for 42 next week and hope that NEO will drop to like $10 or something. I'm keep losing on my long position, but that's something that I can't teach you because if you're wrong, you're wrong. That's a different topic, right? So, but that's the option. So put option is going to work exactly opposite. The sharper the decline of the stock, the more you are going to love it, and it's going to keep going up. So it's a profile is like so. Let's do it. Let's buy a put option. Buy one. Hold on. I know we're running out of time, but we can leave it and then come back. So NEO 20. So let's this one right here, right? And no, not sell. Buy one NEO 9th October. That's 5 days only. 20 put at 42 cents, right? So that basically is gonna be a fair deal. I can go and buy it and protect my 100 shares. Or I don't want to protect my share. I'm just brutally short on it. I'm gonna go for it. I don't care if $42 are gone. I'll go for it. That's the power of options. It can make you, like, if you are right on things, it can make you very quickly. That 42, how they converted into 450. And I took an extreme case. NEO going at 15 in 1 week, probably not a reasonable, but even at maybe, at let's say $19, right? NEO can go to 19 easily, right? So NEO, we'll talk about NEO next week when we come back, how it behaved. But $58 made on $42 investment, that's more than 100%, right? Right there. So so that's what I'm talking about. Like if you are but don't play too much with your money, right? Don't go crazy about it because yes, you made money, but what if NEO keeps going up, then you lose from $42. Now it's good for fun, $42, but if it works, then it works. It can keep going. So, but anyways, I'm not gonna go through all of that. So So yeah, this works very similar. I think you got the idea. Your profile is right there. Do we have okay, I think we're running out of time. There's two things that I want to talk about. Like, in my opinion, what is how you should play these things. I think it's more involved. And then I want to give you some takeaways on how to start this. And then that leads into our second session, which is pricing. Want to talk a lot about pricing, option Greeks, Vegas, deltas, thetas, and gammas. Volatility, when to buy, when not to buy, buy versus selling. But I don't know. It's an hour, and that's what I thought most people allocated for themselves. So I am okay to stop, and I think I can make it up next week. So I'll turn it back to you. And if there are any questions, or I'm here to stay. I can stay more, but I think we should stop here.
Thank you so much, Dr. Raheel. We have another question in the chat box.
Oh, sorry. All right. can we buy put on already bought stock? Oh, yes. Oh, yes, anytime. You can buy put options anytime, but only in the market hours. You don't buy them right now because options are not like stocks. There's no such thing as pre-market and after hours. They are only traded in the time because of the liquidity issues. So can we buy put on already bought stocks? Yes, you can always buy anytime. Or buying stock plus put has, oh yes, all the time. We'll talk about that. Very good question. Yes, that's all the power. Stock versus, leveraging, buying stock and hedging, through put options, or actually, I like this, buy the stock and sell the call option. That's probably even better. But yes, that's all next 4 weeks is all about. Combinations, combos, buying two calls, hedge straddles or straddle strangles, butterflies, condors, calendars, all those. But yeah, we were just getting warmed up here. And I am sorry it took me an hour just to, maybe I went too much deeper into it. But there's no point of actually not discussing the details. So
thank you so much for such a detailed and informative session. So if anyone have any questions, you can ask right now. You can go on unmute and ask away.
Hello, Dr. Raheel. Thank you so much for the session. It's really informative. I just had a question about covered calls. If you can, briefly explain those.
Yes.
Like I'm holding.
Yeah, go ahead.
I'm holding some shares of Planter, and I want to sell. I want to sell covered calls on that.
Yes, sure.
So I want to make money and get rid of my shares as well on the top of it.
So there are different ways to do it, and that's my goal is to go through those. So basically, if you are holding, first thing you have to have at least 100 shares of that, because one contract of the option is actually going to be written on 100 shares.
Exactly.
So do you have?
I have like 700 shares. So
very good. So the way you should do is this: you should, in my opinion, if you think, first of all, those shares you have unlimited time to hold, but you can sell some call options on them. So basically give the other guy time for 1 week and say, okay, you take it, and I will, don't sell for all 700, because if you are on the loss on that, what if it bounces sharply? So every week you sell 300, three options. Three options on it. Get premium. I do that also. If the stock went down on me, I always sell. So basically, if you're holding 200 shares of something, sell that one call option every week. So if the stock goes up, you always are the winner because you have 200 shares. One share is going to be offset by the call, but the other one will deliver for you. But if it goes down, then keep taking the credit of the call option you sell. That's the way to play those.
Exactly. All right. Thank you so much.
Is there a recording session staying longer? Yeah. I mean, I'm generally fine. I can keep talking for days on this, but for the interest of other people, I was told to make it in 1 hour, so that's why I stayed in within the hour. But I don't have any problem making them, a little bit longer. I mean, this is, as I said, I've taken full-time courses on this thing. This is not a joke like you learn in 30 minutes. It's not going to happen. It will actually damage you. So the more detail we go, the better it is, and it build on it, read about it. I mean, there are some links which are out there that I put for some education. I mean, I know you guys are smart. We are very smart people from us. So I mean, engineers mostly, they pick it up very, very quickly. So there are some good, links that just for your, understanding. But generally, I've seen in life the engineers, they like the graphs and deltas and thetas and derivatives and all that. So they will pick it up very quickly. The others also, I mean, there are people who don't have much education, but they pick it up very quickly. So yes, I mean, it's a slow process. Unfortunately, I can't do it in 1 hour.
Thank you so much, Dr. Raheel. Unfortunately, we cannot continue for longer today, but inshallah for the next session, maybe we can allocate more time.
Inshallah. Thank you very much, everybody. I really enjoyed it, and we'll look forward to more sessions. Thank you.
Thank you so much. Thank you.
Thank you, sir.
Bye-bye.